Hey everyone, let's jump straight into this explainer. Today, we're unpacking exactly how you can generate secondary income from the stock market without being chained to your desk all day. So if you've ever felt like the market is this massive opportunity, but you just literally don't have the hours to dedicate to it, you're in exactly the right place. Look, if you're working a 9 to 5, you probably already know that day trading is incredibly stressful. Staring at 5 different monitors, tracking every tiny fluctuation, while, trying to actually do your real job. Yeah, that's just not sustainable for most of us. But on the flip side, long-term investing, where you lock your capital away for a decade and just cross your fingers, it doesn't really satisfy that itch for active, measurable income, does it? It's a really common frustration. Well, the solution to this whole dilemma is swing trading. It's this beautiful strategy that perfectly balances risk, reward, and most importantly, your time. Instead of sweating over minute-by-minute charts, you're just looking to capture a chunk of a larger market move, one that unfolds over days or maybe a few weeks. The goal is simple. You buy right before a short-term upswing or sell right before a downswing. And the best part, it only takes about 10 to 15 minutes of your attention a day. So, here's our roadmap for today. We're going to cover the trading middle ground, the mechanics of a swing, the power of delivery data, some proven swing strategies, and finally, we'll wrap up with the risks and realities you need to know. Okay, Section 1, the trading middle ground, finding the just right strategy. Let's make sure we clearly define where swing trading actually sits in the financial landscape, so you don't confuse it with anything else. I like to think of this as the Goldilocks paradigm. Day trading, way too hot. Traders are stressed out, they're heavily leveraged on margins, and they're literally watching every single tick. Long-term investing, way too cold. You're digging deep into balance sheets for a 5 to 10-year horizon. But swing trading, it is just right for the busy professional. You're using your own capital, not crazy intraday margins, and you're relying mostly on technical analysis to hold a position for just a few days to maybe a few months. Moving on to Section 2, mechanics of a swing, catching the natural market wave. To pull this off, you absolutely have to understand how a stock actually moves, because, spoiler alert, they rarely travel in a straight line. Think of these market trends like ocean waves. You don't need to cross the entire ocean. You literally just need to catch one good wave. That's the swing. Whether a stock is trending up or down, it naturally breathes. It pushes forward, pulls back a bit, and makes these higher highs and higher lows. Swing traders are essentially the surfers of the financial world. We're just sitting there waiting to ride that one specific wave of momentum. But to catch those waves safely, you have got to follow some rules. Rule number 1, stick to highly liquid, large-cap stocks. Think Nifty 100 companies. You need to know that when you're ready to exit a trade, there's a buyer waiting for you. People get tempted by penny stocks because they're cheap, but guys, playing with illiquid penny stocks is pure speculation. It's not a strategy, it's just dangerous. By sticking to large caps, even if your timing is slightly off, your capital is sitting in a fundamentally solid business. It dramatically reduces your chances of a total wipeout. All right, Section 3, the power of delivery data, tracking where the smart money goes. This is where it gets really fun, because this is where we stop guessing and start tracking exactly what the massive institutional players are doing. You see, there's a huge difference between day traders playing with leverage and serious investors putting real money on the table. A day trader only needs about 15 to 20% margin to buy a stock, and they're going to dump it by the closing bell anyway. But when someone buys a stock and takes delivery, meaning they actually hold it overnight, they have to deploy their full capital. That shows total commitment. It means they're actually investing in the asset, not just placing a quick bet. Let me show you how this plays out in the real world with Maruti. Right before the stock had a massive breakout to 9,500, something crazy happened. Typically, its delivery volume hovered around 44%. But just days before their quarterly results, while the stock price was completely flat, the delivery volume suddenly spiked to 61%. So the price isn't moving, but someone with very deep pockets is quietly accumulating a ton of shares. And that brings us to a massive clue. If you see delivery percentages spiking, usually over 40% or 50%, in a sideways market, an explosive swing is likely right around the corner. The surface looks calm, but underneath, the smart money is moving in. As a swing trader, if you can spot that hidden delivery data and pair it with a price breakout, you've just found a beautifully validated, high-probability entry point. Let's get into Section 4, proven swing strategies, the actionable playbook for consistent returns. Theory is great and all, but let's talk about the actual mechanical playbook that's going to protect your capital and generate returns in just 15 minutes a day. At its core, your daily routine comes down to 3 steps. First, you identify a strong trend or a tight consolidation. Second, you wait for the setup. Maybe it's a pullback to a moving average or one of those delivery data spikes we just talked about. And third, you execute. But please, look at step 3 very closely. You never ever enter a trade without a strict stop loss. You aren't guessing here. You're systematically scanning for these exact criteria. Let's look at one of the most famous strategies in action, the moving average crossover using the 50 and 200 period averages. This is a real trade on ITC on a 1-hour chart. The golden crossover happens when the fast 50 period line crosses above the slow 200 period line. That right there is your big flashing buy signal. So in this example, a trader buys in late January, and then they literally just hold it. They ignore all the daily noise for months until the death crossover in August tells them it's time to sell. That single, highly patient ITC trade generated a 35% return. Just think about that for a second. A really good fixed deposit or a safe index fund is going to give you what, maybe 6 to 12% for the entire year? By just patiently riding one well-researched swing, you've blown past those traditional returns, and you didn't have to stare at a screen for 8 hours a day to do it. Now, as you get more comfortable, you can start adding in advanced tools for extra confirmation. Things like the MACD, the RSI, to see if a stock is overbought or oversold, or Fibonacci retracements. You absolutely don't need to use all of these at once. But imagine your delivery data shows a spike. The RSI says the stock is oversold, and the price is bouncing perfectly off a 61.8% Fibonacci level. That's when you know you've got an incredibly strong setup. Which brings us to Section 5, Risks and Realities, the sober truth of market exposure. As much as I absolutely love swing trading, it is time for a reality check. Because understanding your risk is literally the only thing separating professional traders from people who are just gambling. So what's the catch? Well, because you hold stocks overnight and over the weekends, you're exposed to sudden news. If terrible news breaks on a Saturday, the market might open on Monday morning significantly lower than your planned exit point. Plus, since you aren't closing out your trades on the same day, brokers aren't going to give you that massive intraday leverage. You have to use more of your own upfront capital to see meaningful profits. This is why risk management is 100% non-negotiable. Before you ever hit buy, you must know your exact profit target and your exact stop loss. Never risk $1 unless the math says you can make 3. If you are placing a trade based on hope, or if you don't know exactly where you're going to admit defeat and take a small loss, you honestly have no business hitting that buy button. So, I want to leave you with this question. Armed with this knowledge of delivery data, moving averages, and strict risk management, are you finally ready to catch your first big swing? The market creates these natural waves every single week. With just 15 minutes of discipline a day, generating a real secondary income is entirely in your hands. Thanks for hanging out with me for this explainer, and I'll see you on the next one.